Welcome to the Deep Dive. Today, we're digging into a really interesting report from Jefferies. It's dated May 8th, 2025,
That's right.
and it's looking at some, well, potentially quite significant movements in Asian currencies and also what's going on with asset prices in Hong Kong.
Exactly. And I think what really grabs you about this report is the suggestion that maybe, just maybe, the U.S. dollar's long period of strength could be peaking,
Hmm.
which, could mean we're entering a time where Asian currencies start to gain some ground. And yeah, there's some fascinating stuff happening in Hong Kong property too.
Okay, so the mission for you, listening in, is to sort of walk through this Jefferies analysis with us. We want to pull out the key signals, the important takeaways about what's shifting in the Asian financial world, but, without getting totally bogged down in technical jargon.
Right. It's all based on Jeffries looking at the financial data, market moves, that kind of thing.
So let's jump right in. The thing that really leaped out, at least to me, was this sudden, very sharp rise in the new Taiwan dollar.
Yeah, that's definitely the headline grabber here. The report calls it an extraordinarily sharp appreciation. We're talking the week leading up to May 8th.
Okay.
Over that week, up to the Monday, it surged 7.8%. And get this, the Friday just before that, it jumped 3.8% in a single day,
Wow.
which apparently is the biggest one-day jump since way back in 1983.
1983.
That's
That's
a
a
lot.
that's a serious move. So how are they reading this at Jefferies? Is it just noise or something bigger?
Well, they're interpreting it as a pretty strong signal. Maybe, the clearest sign yet that the US dollar might have actually hit a major peak.
That'd be cooker.
And the implication isn't just a short-term thing. It could potentially be the start of a more sustained appreciation for Asian currencies generally.
Interesting. Now, the report also talks about Taiwan's sort of long-term economic strategy, calling it a supreme mercantilist. What does that mean in this context?
Right. So for decades, Taiwan's playbook has been very focused on exports, keeping exports competitive.
Hmm.
And the report quantifies this. Their real effective exchange rate, basically. The currency's value adjusted for trade and inflation actually declined by 28% between early 1994 and March 2025.
Declined, even with a strong economy.
Exactly. That's the surprising part because over the last 10 years, they've run an average current account surplus of 13.3% of GDP. Huge surpluses.
Right, selling way more than they buy.
Precisely. That surplus grew from just over 1% back in 98 to over 14% in 2024. Yet the currency got weaker in real terms.
So what gives? Why wasn't the currency reflecting that strength?
The thinking, according to the report, is that Taiwan's central bank prioritized protecting older export sectors, steel, petrochemicals.
The traditional stuff.
Yeah, the traditional industries. And keeping the currency somewhat suppressed helped them compete globally, perhaps even at the expense of letting the currency strengthen, which might have actually benefited, say, their big tech companies like TSMC.
Okay, that makes sense. So this big jump now, it kind of hints that maybe that long-standing approach is changing, or perhaps there are other forces at play.
It certainly raises that question.
Did other currencies in Asia move along with the NT dollar?
Yes, they did. And that sort of bolsters the idea that this isn't just a Taiwan-specific story.
Okay,
The Korean won, for instance, was up 2.3% against the dollar over that same week.
right.
And the Singapore dollar, which is usually seen as a pretty stable anchor, gained 1.3%. The report even suggests the Sing dollar might have more room to run, though it's still about 7.5% off its peak from back in July 2011.
So if this trend holds, this strengthening of Asian currencies, what does that mean for global investors? The report suggests some strategy adjustments.
Yeah, this is where it gets practical for portfolio managers, even though a stronger currency can be a headwind for export-heavy companies.
Makes their goods pricier overseas.
Exactly. Despite that, the report makes the case that global investors, whether they're in stocks or bonds, should probably think about increasing their allocation to Asia.
That's a pretty bold call. What's the underlying logic?
Well, it ties back to that idea of the US dollar potentially entering a longer-term decline. That currency shift, plus, ongoing worries about the U.S. fiscal picture, the report mentions that net interest payments and entitlements were still eating up something like 94% of federal receipts in the year to March 2025.
Still very high.
Very high. So all that strengthens the argument to maybe trim holdings of U.S. Treasury bonds. It kind of builds on ideas we've seen before, like in that Stephen Marin paper from late 2024.
And that huge NT dollar appreciation we talked about, that plays into the bond argument too, right?
Absolutely. I mean, if you're a Taiwanese investor, that 7.8% currency gain wipes out any yield advantage you might have gotten from holding U.S. bonds instead of Taiwanese ones.
Right. The Taiwan 10-year yield was much lower.
Yeah, it was only about 1.53% on May 8th, actually down slightly.
Hmm.
And when you consider Taiwan holds, what was it, U.S. $295 billion in treasuries, and Korea holds U.S. $125 billion, these currency moves are a big deal for their returns.
The report, so it's this idea of a potential deal, maybe some pressure from Washington involved in this NT dollar move. What's that about?
It's speculative, of course, but the report raises the possibility. Could this sudden appreciation be partly a response to U.S. pressure?
Pressure related to what?
Well, the idea, maybe an unspoken one, is around the U.S. security guarantee in the region. Is there an expectation that, in return, countries like Taiwan hold lots of long-dated U.S. debt? Miran even mentioned those century bonds.
Ah, right.
So the report flags this as a possibility, this link between security and treasury holdings, potentially influencing the currency move. But importantly, it's not predicting some mass dumping of treasuries by Taiwan or anything like that, just that pressure might be a factor.
Okay. Let's shift gears to China.
Yeah.
What does all this currency action mean for the renminbi? There have been calls for it to weaken.
Well, the report suggests this recent strength in other Asian currencies should probably dampen those devaluation calls, at least for now.
Okay.
And actually, the renminbi itself has strengthened a bit, too. It was up 0.9% against the dollar in the past week, hitting its highest level since November 2024.
So the report's outlook is still for the renminbi to potentially gain value.
That's still the underlying view, yes. Driven largely by China's absolutely massive trade surplus, it hit an annualized U.S. $1.08 trillion in the 12 months to March 2025.
Wow.
With that kind of trade performance, the argument goes, appreciation seems more likely than devaluation. So the advice for global investors is still to consider having exposure to both Chinese stocks and Chinese government bonds.
Right. Now let's talk Hong Kong. The report mentions upward pressure on the Hong Kong dollar. How does that work, given the peg to the U.S. dollar?
Yeah, that's the crucial point. Because it's pegged, the Hong Kong dollar itself can't just rise against the U.S. dollar like the NT dollar did.
So the pressure has to go somewhere else.
Exactly. It spills over into the local financial system. And what we're seeing, according to the report, is that pressure pushing down local interest rates quite dramatically.
How dramatic.
Well, the one-month HIBOR, that's the key interbank lending rate, fell 197 basis points down to 2.09% just since April 29th.
That's a huge drop in a short time.
It is. And 189 basis points of that drop happened in just the 3 days before the report.
Okay, so falling interest rates.
Yeah.
What does that mean for, say, the Hong Kong property market? It's had a rough time.
That's the implication. Since the currency can't adjust, this upward pressure flows into local asset prices. And the report suggests this makes it more likely that Hong Kong residential property might be finding a floor, nearing a bottom.
Are there other factors supporting that view?
Yeah, a couple of things. Rents have been rising. Mass market rents were up 4.6% year on year in March. So the gross rental yield, around 3.7%, is now getting pretty close to the cost of actually financing a mortgage, which was around 3.5%.
The economics are starting to align better.
Exactly. And the report also notes that if the Fed were to start easing policy again down the road, that would be another tailwind for Hong Kong property.
And we should remember how far prices have fallen there.
Yes, absolutely. The report states Hong Kong residential property prices are down 28.5% from their peak back in August 2021. That's a very significant correction, the biggest since the Asian crisis, actually.
So has this changed Jefferies' view on specific investments?
It has. They mentioned explicitly that because of this dynamic, the currency pressure, the potential property bottom, they're adding Sun Hung Kai properties back into their China portfolio.
Replacing China overseas land.
Correct. And they're also bumping up the overall weighting for Hong Kong in their broader Asia-Pacific ex-Japan portfolio by 2 percentage points. They're funding that by trimming a bit from China and Korea.
Okay. The report also connects the dots between potential Fed easing and U.S. tariff policy. How does that fit in?
Well, it highlights the uncertainty. How much the Fed might cut rates really depends on what happens with Trump's tariff plans and the whole US-China relationship.
Right.
The market, judging by the S&P 500's recovery, seems to be betting that the tariffs will either be abandoned or significantly watered down.
But there's a potential catch.
Yeah, the report raises a counterpoint. Maybe the strong stock market actually makes Trump feel like he doesn't need to back down on tariffs. It's a bit of a feedback loop.
And what about Treasury Secretary Bessent's view?
He's apparently been suggesting a de-escalation in the U.S.-China tariff situation is likely in the very near future. The report notes this fits with his past comments about Trump's tariff talk being partly a negotiation tactic, the New York real estate style.
Stepping back again, what about longer-term market trends mentioned in the report?
A key one is reinforcing that view.
Right.
The U.S. dollar likely having entered a long-term downtrend.
Which is good for.
Good for U.S. companies with lots of overseas earnings because those foreign profits translate back into more dollars.
Right.
So they remain more positive on U.S. equities compared to U.S. treasuries in the long run. However, they also think the U.S. has probably hit its peak weighting in global indices like the MSCI All-Country World Index. That expected dollar weakness is a big reason why.
They give an example of that currency impact, don't they?
Yeah, as of May 7th, the S&P 500 was down about 4.3% year-to-date in U.S. dollars. But if you measured it in euros, it was down 12.7%. Big difference. And they also note that the chart for the MSCI AC World ex-US index looks like it might be ready for a breakout. Suggests strength potentially shifting outside the US.
And for Asia specifically.
The focus is maybe shifting a bit more towards domestic demand plays within Asia, rather than just the export-oriented companies. Sort of echoes how things were before the Asian financial crisis.
Interesting. The report then includes a personal anecdote about Israel. How does that fit into the financial discussion?
It's a grounding reminder, isn't it, of the geopolitical risks that are always there. The author mentions arriving in Tel Aviv shortly after a missile strike near the airport.
Yeah, it's sobering.
But it also highlights Israel's economic resilience despite all that. The main stock index, the TA-125, hit a record high. GDP growth was strong in late 2024.
And Al's stock price.
Yeah, up 387%, because they kept flying when others stopped after October 2023. It shows how specific companies and the economy can adapt. The report does briefly touch on local politics, mentioning negative views of Netanyahu in Tel Aviv, but cautions that might not reflect the whole country.
Okay. Another specific point was Saudi Arabia increasing oil production. What's the story there?
Right. OPEC plus production going up by about 411,000 barrels per day in June. And the timing is interesting, coinciding with Trump's planned visit.
So, speculation about a link.
There's definitely chatter, yeah. Is it just about cracking down on cheating OPEC members, or is there more to it? Maybe something related to Iran? The report doesn't give an answer, but notes the speculation.
And Saudi Arabia's own finances play a role.
Possibly. Their current account actually slipped into a small deficit in 2024, which is a big change from the surpluses they had in 2022 and 2023. So maybe they need the revenue from higher production.
Finally, the report looks at some recent election results, Canada and Australia. What's the takeaway?
It notes that right-leaning candidates lost in both countries recently. The report links this tentatively to what it calls the Trump factor.
Okay.
Mark Carney won in Canada. In Australia, Anthony Albanese got re-elected despite polls looking tight earlier. And the Conservative opponents in both cases actually lost their parliamentary seats.
And the Australian economy.
Described as subpar growth, but no major downturn. Household spending recovered a bit. The Reserve Bank cut rates earlier this year, and more cuts are expected as inflation has eased.
What about jobs and housing there?
Job growth has been mainly public sector. Private sector slowed. Productivity's down. Investment isn't particularly strong. But the housing market, especially Sydney, has been boosted by post-pandemic immigration.
Although there's pressure to cut immigration now.
Yeah, the government plans to have net migration. Stock-wise, MSCI Australia looks expensive relative to earnings. Banks have done better than resources lately. Gold miners are still a favored sector.
And all feeds back into their portfolio recommendations.
Exactly. The report ends by summarizing their recommended weights for Asia Pacific ex-Japan, overweight China and Hong Kong, underweight Australia and Taiwan relative to the benchmark. And it lists their specific holdings in the China long-only portfolio.
Okay, so let's try to pull this all together. The big themes from this Jefferies deep dive seem to be, one, this potential turning point for the U.S. dollar, maybe the start of a longer-term weakening trend.
Right, and flowing from that, the possibility of sustained strength in Asian currencies.
Two, the really varied ways this is playing out across Asia, that dramatic NT dollar jump, the knock-on effects in Korea and Singapore, the unique situation in Hong Kong with the peg pushing down interest rates and maybe supporting property prices.
And the renminbi looking more likely to appreciate than depreciate, given China's trade surplus.
And three, just how interconnected everything is. U.S. tariff policy, Fed decisions, geopolitics in the Middle East, even election outcomes in Canada and Australia. It all feeds into the global market picture.
Absolutely. And I think if there's one sort of central signal highlighted here, it really is that NT dollar move. The report frames it as potentially a really significant indicator of broader shifts happening.
So hopefully understanding these dynamics, these potential shifts that Jefferies is pointing out, gives you a clearer lens for looking at global investments and the economy going forward.
Which leads us to, I suppose, the final thought for you tonight on. Given these big currency moves, these potential policy shifts, what are the less obvious ripple effects we might see? The second-order consequences for trade, for investment flows that maybe aren't immediately apparent. What happens next?
Definitely something to ponder. Thanks for joining us for this deep dive today.
Thank you.
We'll catch you on the next one.